Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Standard Chartered Money Insights. My name is Marco Iachini, and I'm a cross-asset strategist from our CIO team. On this episode of the podcast, we'll discuss the latest FOMC minutes, as well as the China regulatory crackdown. Joining me today for this conversation, I'm glad to welcome Abhilash Narayan, Senior Investment Strategist. Without further ado, let's kick off today's conversation. Now, Abhilash, I wanted to ask you about the latest FOMC meeting minutes and what are the implications out of them in relation, obviously, to the move in bond yields lower. So what's your take on this and what can you tell us?
Thank you, Marco. Clearly, the FOMC meeting minutes which were released were highly anticipated one, and they showed that there is an ongoing debate whether the economic recovery is justified to warrant a sooner than expected tapering. And the minutes noted that the condition of a significant economic recovery is a high bar, which we think hasn't been met yet. So we continue to expect the Fed to start tapering bond purchases in early 2022. So overall, the FOMC meeting minutes were a bit more dovish than what markets were expecting. But they alone do not explain the sharp move we have seen in bond yields over the past week or so. And we think a couple of other factors do contribute to explaining the lower bond yields. Firstly, we think that economic data surprises have tapered off, and they have been a factor towards dragging the yields lower. And secondly, we have seen an easing of inflation expectations. Now, economic data surprises are usually mean reverting, so we think that the impact from them is a short-term impact. Though the same cannot be necessarily said about inflation, and we'll have to wait and see whether inflation does indeed prove to be transitory. So at present, given that the yields have held a technical support level of 1.27 to 1.29%, we think that they may have found a base. Now, in the short term, they could obviously go ahead and test 1.20. But over the next 6 to 12 months, we think that 10-year yields should move back up to 1.75%.
Thank you, Abhilash. So then, given these, assumptions or forecasts that we have, what would be the asset class implications that you foresee?
Well, there are some really interesting implications from our perspective. So firstly, if we look at equities, in the past couple of weeks, we have seen growth style outperform value style as yields have fallen. But given that we think that we are close to the bottom in terms of yields in the near term, it seems to us that the risk reward favors going into or adding to value style equities. If we move to bonds, we think that a rotation from investment grade bonds to high yield bonds could be something that investors could consider, because usually investment grade bonds are hurt more when yields rise given their higher interest rate sensitivity. And lastly, we think that a rebound in yield could be negative for gold in the short term, and 1750 is a key technical support level that we are looking at. But on a 12-month horizon, we think that gold could easily, breach $1,900 per ounce.
Thank you, Abhilash. Now, I wanted to shift gears a little bit and talk about the elephant in the room here. The regulatory crackdown that is happening in China obviously is top of mind for investors. This is not new, but obviously we've seen some more developments in the space recently. So I was wondering what your take is and what's the outlook as well for Chinese equities.
Well, clearly, there is going to be increasing regulatory pressure on China's internet sector. And, the latest probe into one of the US listed companies is just another example in that trend. Now, from a funding perspective, obviously, this raises the bar for raising capital for Chinese tech companies, especially in international markets, where they also face the additional headwind that, the SEC could announce a policy addressing potential delisting of foreign companies that do not satisfy the auditing rules. So from an international funding perspective, there are clear headwinds. Now, if we look at some of the sectors that saw similar regulatory pressure in the past in China, The one example that stands out is the Macau gaming sector, which came under scrutiny between 2014 and 2016 when China had the anti-corruption campaign. And during that time, the sector underperformed Hang Seng Index by more than 50%. More recently, Chinese property sector has also been under pressure given the three red line policy. And there again, we've seen the sector underperform Hang Seng Index by more than 15%. So when we look at these past examples, I think it's fair to say that Chinese internet sector could remain under pressure for the next few months. However, one thing that's different for Chinese tech sector is the fact that it has a greater strategic importance than arguably gaming sector does. And hence we think a neutral stance on Chinese equity sector is warranted. Now, within China, we think that energy and industrial sectors are the ones which are best poised to outperform the broader market over the next 6 to 12 months.
Thank you, Abhilash. Those were very useful comparisons, and at least investors can have some sort of guidelines in mind when looking at how far this trend can go. Now, to finish off this episode, I wanted to touch on the energy sector, specifically what has happened with the latest OPEC Plus meeting developments. What's your take, and what does it mean for some of the asset classes involved?
Well, clearly, the failed attempt to resolve the deadlock between UAE and Saudi Arabia does raise some near-term risks to oil prices. Now, we saw oil prices rise earlier in the week before they normalized. So, in the near term, the volatility for oil prices could remain elevated. In the long term, obviously, there is a risk that this disagreement could lead to reduced compliance from OPEC Plus members, and that could lead to increased supply risks for oil out there. But if you take a look at the demand picture, we still think that the demand is likely to grow at a decent pace over the next 12 months. And that means for the next 6 to 12 months, our oil price outlook remains broadly unchanged. So we expect oil to range between $75 to $80 per barrel. So there is limited upside for oil prices from here on, but equally important is the fact that we don't expect a sharp downside from here on. Now, if you look at asset class implications, the first one, if you look at in terms of the bond asset classes, is emerging market dollar government bonds, which generally have been correlated to oil price. Now, given that this asset class also has a high sensitivity to 10-year treasury yields, we think that an increase in 10-year yields could pose a short-term headwind to emerging market dollar government bonds. But if we do see a modest increase in oil prices from here, and when we combine that with the attractive yield and modest valuations that the asset class offers, we think that it can still outperform broader bond markets over the next 6 to 12 months. Moving on to equities, we continue to like energy sector across most major regions. And we did discuss that we don't see a lot of upside in oil prices from here on, but we do see an upside in demand, right? And for oil producers, while the absolute level of oil prices matters, what also matters is how much oil are they selling. So while oil prices can remain broadly stable, if the demand does increase, then that should translate into stronger earnings for energy sector companies going forward.
Fantastic. That was very insightful. So thank you again, Abhilash, for joining our conversation today. That is all for this episode of Standard Chartered Money Insights. If you would like to learn more or read our publications, please visit our website at sc.com under Latest Market Insights. As a reminder, if you enjoyed our discussion, please rate and review us wherever you get your podcast. Thank you for joining us.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.